I would argue jazz is the musical genre most applicable to real estate because jazz is all about improvisation, and improvisation is critical to the successful execution of real estate investing and operations. Let's face it, people who can't improvise really have no business in real estate. So kudos to this program's producer, Sandy Terranova, who is also our musical director. I hope you enjoy that intro. With that, I want to bid you all a good day. Thank you for joining us for our quarterly update on REIT performance. This will be for the second quarter of 2025. My name is Mike Consol. I'm editor of Real Assets Advisor magazine, one of six titles published by Institutional Real Estate Incorporated, which is co-producing this webinar with Nareit. Nareit, the National Association of Real Estate Investment Trusts, and Nareit is being represented by, could you have a better name and be in business? John Worth. John Worth, Executive Vice President of Real Estate and Investor Outreach for the and John Worth. You're going to find he is just a motherload of information. Also joining the discussion is Brandon Benjamin, a fellow who has been saddled with two first names. I almost called him Benjamin Brandon at one point. He's director of real estate securities at Brookfield Asset Management. That's a Canadian firm, but Brandon is eating deep dish pizza in Chicago right now. So he is in the Windy City. He's right here, south of the border, south of that Canadian border. And we're looking forward to their insights on REIT investing and REIT performance. To our audience now, those of you, I think many repeat people today, professionals, which we're really pleased about. We invite you, as always, to submit your questions in writing, and those questions will be answered as we go along. Those of you who have been there before know that we really do integrate your questions into the proceedings, and we don't want you out there being potted plants like on most webinars. We want you interacting with us. We'll make sure that that we take full advantage of those questions and have our professionals answer them for you. Also, important to remember that there will be a recording of this webinar and the slides that you will see. They will be sent to all registered participants. And the webinar will also be published on both the IREI and Real Assets Advisor websites. John Worth and Brandon Benjamin, welcome to the both of you.
Thank you. Thanks for me.
Thanks, Mike. Great to be back, and very excited to have Brandon with us, who has a long association with Nareit, including working at Nareit when he was in his teens, as I understand it. So,
in his teeth. I'm sorry you didn't make the cut, Brandon, but you know, Brookfield's not a bad secondary assignment. So.
Yeah, no, it certainly is not. Glad to be here, and thanks again for having me. A long time advocate of listed real estate and all real estate commercial. So thanks again for having us here.
We cannot have this discussion without a good jumping off point. And John, every quarter you give us the quarterly rundown of how REITs performed during the second quarter of 2025. You got some slides to show us. Get us up to date. Give us some talking points here so that we know we can take some direction with this discussion. What say you?
Absolutely, and we're going to have to table our discussion on whether jazz or heavy metal is the best analog for commercial real estate.
I like them both.
So I'm going to share my screen here and provide just a couple slides to put some context around our discussion today. And so just starting with quarterly returns for the FTSE Nareit All Equity REIT Index. This is kind of the broadest based U.S. REIT index, comprehensive of all the property sectors that make up the REIT world, including data centers, cell phone towers, healthcare, and as well as the more traditional real estate sectors. And as you can see, REITs fell by just under a percentage point this quarter. Although I think that really doesn't quite show the dynamics of the quarter. It was really quite a wild ride in this quarter. REITs fell by 2% net in April. After very large declines following the tariff announcements, or it's sometimes referred to as Liberation Day. REITs fell about 12% in the trading days after that announcement, and then rose by about 7.5% after the postponement of the announcement, and ended up for the month just down 2%. REITs were up 1.2% in May, and then we're essentially flat, just down less than a percentage point or down less than 1/10% in June to end the quarter down just under 1%. Ended with year-to-date returns up 1.8% for the year at the end of June. As of yesterday's close, REITs were up about 3% for the year. July has been they were up about 1.2% so far in July. REITs have given much of that back in today's trading after the CPI announcement and rise in the 10-year Treasury, plenty of which we'll get into later. When we look at property sector performance, and here we're showing year-to-date performance on the left-hand side and second quarter performance on the right-hand side. Just going down the year-to-date performance, we see very strong performance from the telecommunications cell phone tower sector, up nearly 20% in 2025. A large bounce back from really, sort of a year and a half, 2 years of underperformance. Gaming doing very well, up over 10%. Healthcare continuing to do very well, following on a very strong performance in 2024. When we look at the underperformers, we see lodging resorts, data centers, office, and timber all underperforming on a year-to-date basis. I know we'll get into the drivers of some of those. And in the second quarter, we saw the best performing property sector was actually sort of our catch-all, the specialty sector. Data centers up over 7% and a significant bounce back, and hotels and office, two of the underperformers for the year, saw a recovery in the second quarter. And really, in terms of the underperformers, we saw timber down 13%, and industrial and residential both lagging the index. Last thing I'll just show on the slide, and then we'll jump into the discussion. Just some of the dynamics globally this year, this has been a really interesting year globally. Obviously, these are dollar-denominated returns, and the dollar has depreciated pretty significantly against both the euro, the yen, and a basket of global currencies. So that colors these returns versus their home country returns. But we see Europe significantly outperforming the US, developed at nearly 25% returns on a year-to-date basis through June. Developed Asia up nearly 18% on a year-to-date basis, and the US global index flat. This is an index that doesn't include cell phone towers. Thus, the delta between the US returns and the North American global return. And this is really unique. The U.S. index has outperformed global indexes actually 7 out of the prior 10 years, and the average return over the last 10 years for the U.S. Has been significantly higher than global returns. Up for the U.S. that's about 5%. Both Europe and Asia are both less than 1%. So this has been a real turnaround in terms of the global returns structure, and I won't go into each of the sectors, but there's a number of sectors where we're actually seeing, sectors where we're seeing U.S. not performing well, the global counterparts performing quite well. Office is a great example. So with that, let me stop sharing, and I'll kick it to you to jump into the discussion.
Sure. I have to say, John, I think rock music or heavy metal is the construction phase of property development. And then comes all the nuance of jazz and improvisation of jazz for investing and operating. Now, we just saw on what you presented there that data centers are underperforming year to date, and cell towers are outperforming so far in 2025, which is pretty much a complete reversal from last year. I want you to explain that, but I'm also just of the mind that everybody looks at data centers and they think there's just no end in sight for data centers. They can't build enough of them, and yet we see some underperformance. Maybe you can address that as well as the delta or maybe not delta, the chasm between telecommunications and data centers.
For sure. And I think with data centers, the right analogy is very, and the turning point for data centers, just keeping in mind data centers returned over 30% in 2023, over 25% in 2024. And so showing very significant outperformance versus the index and tremendous growth. And we really saw data center returns sort of switch gears on the DeepMind announcement earlier this year, which suggested that maybe the need for AI-driven data center compute wasn't as large as some people had previously thought. I would say I think that is still very much out for debate. We're seeing a lot of data center development. We're seeing some of the major players suggest they through their actions that they think they need enormous amounts of compute power for AI model, both training and running. And then I think the analogy that some people have said is, it was like you thought data center demand was going to be an extra large pizza, and it turns out it's just going to be a large pizza. It's still a lot. It's just not as much as you might have thought. So we saw REIT returns reflect that, and then more recently we've seen some REIT returns reflect exactly what you pointed out is this dynamic of this is a business that's going to require a lot of capex. And I think investors are still wrestling with that. And on the cell tower front, cell towers had really underperformed the last couple of years. Some of the 5G demand that had essentially been priced into cell phone towers was sort of slow in arriving. The view now is that in 2025 and into 2026, the telecom carriers are gonna pick up their demand, and so we've seen the sort of the pure play telecom companies doing very, very well this year. And I know Brandon's. I want to bring Brandon because I know you've definitely thought about this data center issue.
Yeah, but Brandon, before you launch into that, John mentions extra large versus large pizza. He never said whether it was deep dish or thin crust New York style. So you might integrate that into the crust of your comments here.
Listen, I'm a boy from north of Scranton originally, so I'll take the thin crust folded up any day.
Thank you.
The Chicago deep dish. Love Chicago. Nothing but good things to say. Nothing good to say about their pizza. I'm sorry, Chicago. But look, on the data center side, I think John summed up the supply side really well. I mean, as we look at the data and we think about investment, lots of numbers thrown out. Frankly, the numbers seem to change on a daily basis. Just this morning, turning on Squawk Box and seeing Google's investing another $3 billion in data centers. That pales in comparison to the $75 billion, with a B, that they've already committed to this year, growing exponentially year over year. So, when you look forward, McKinsey published a note earlier this year that suggested that given current data center demands as they understand them, some $6.7 trillion, that's with a T, trillion dollars of data center capex will get put to work through 2030. Okay, so the fact of the matter is that there is no lack of supply given the visibility we have today. I think from a public market investor perspective, or from any investor perspective, the real questions are on the demand side. Today, the reason that the data centers are getting put to, the reason that we're building as much as we are is because we look forward, these major tech companies, and we see use cases, we see monetization of the applications. I think the real question that we're thinking about day to day, quarter to quarter, year to year is, what are the use cases? What are the applications? And how soon do we get there? There will come a day, presumably, when the capex going in, which is prodigious, but a drop in the bucket in some sense for these large tech companies, it will have to have some return behind it, or investors are going to become more skeptical. So we're thinking a lot about the demand side. What could put a kind of wrench in the demand side? Is it regulatory? Is it, again, the lack of monetization? Don't know. On the supply side, I think one of the more interesting questions that we're trying to underwrite and that we're thinking a lot about, the president is in Pittsburgh today talking about kind of how do we fuel the energy for this AI boom and for the data centers required. I think that's a big question mark that we're also thinking a lot about. By some estimates, the supply that we just talked about, the energy required would fuel a quarter of American households when it comes to energy. Just to put some context around the size of the pie here, it's an extra large pie, Mike, not a large pie. So, but there are real questions. We are constructive on the space given these long-term trends, but monitoring very closely again the regulatory environment. 10 years ago, many on this call, I suspect, thought that autonomous vehicles would be in wide use on roads today. It's not the technology widely that has kept autonomous vehicles from really proliferating. It's really the regulatory framework around autonomous vehicles in the US and globally. So what does that mean for AI? I don't know, but lots to think about. Supply, demand, as we see it today, very compelling, but a lot of questions to think about and monitor, and exciting times, frankly.
Yeah. John, another thing that we've been thinking a lot about in recent years has to do with the public-private valuation divergence. People have been manipulating the real estate sleeve of their portfolios to try to take advantage of that. Is there what's the status of the valuation divergence? Has the opportunity to take advantage of this divergence disappeared, or is it still sitting there ripe for the exploitation?
No, amazingly, the public-private valuation gap or divergence continues to really sort of be available in a sense that when we think about it in terms of cap rates, there's about a 50 basis point gap in the cap rate spread between REITs and sort of Odyssey appraisal-based valuations versus what we would expect. So today the gap is about a little bit over 100 basis points. Normally, we would expect that to be about 50 basis points at this point in the cycle, and early indications, sort of suggest that gap may actually widen a little bit when all the Q2 data comes in. Odyssey funds were about flat for the quarter. We expect, we know REIT share prices were down a little bit less than a percentage point. We expect NOI to come in we expect pretty healthy NOI growth this quarter. So our expectation is that valuation gap will open up a little bit. And so what is that really, I think, creates the opportunity for yes, opportunistic plays, but also creates the opportunity for, as institutional investors are thinking about how they're using REITs strategically in their portfolios, that really creates a nice entry point. So it can be a shorter term opportunistic play. It can just be a good entry point for a for a REIT strategy, whether that's sort of a completion strategy where you're looking at property sectors, or a global completion strategy, or really just looking to add alpha or outperformance to your real estate strategy.
But as of now, is it publicly traded REITs that are valued higher than equivalent properties in private, or vice versa?
No, vice versa. So if we go back really to the end of 2021 when the 10-year Treasury started rising, what we saw over the course of 2021 was, in the 10-year Treasury rose about 225 basis points. REIT cap rates rose by a little bit more than 150 basis points, and REITs, really meaningfully sold off there in 2022, down almost 25% for the year, and so that was really the valuation moment for REITs, and cap rates have bounced around. They've tightened a bit since then. On the private side, again, looking at Odyssey appraisal-based valuations during 2022, Odyssey cap rates actually fell. So we had this period where Odyssey cap rates were actually below the 10-year Treasury, and then they've been on a slow but steady increase since really the beginning of 2023. But it still hasn't been enough to really close that valuation gap. So, I mean, I would argue that in some sense, REITs may have sort of overcorrected for higher interest rates and then tightened. But on the private side, that incorporating a higher interest rate environment into valuations is still a work in process.
Hmm. So, Brandon, we have a question from one of our audience members asking which sectors have the highest spreads and now versus historical averages. I don't know if you have that at your fingertips, but I know that based on some notes we exchanged, public-private valuation or arbitrage continues to look interesting to you. But can you integrate that question into it? Which sectors look especially promising?
Yeah, I think John hit on it well. That there are some sectors, frankly, in the global universe and in the U.S. specifically, that frankly look pretty on parity with their private market peers from a valuation perspective. There's some sectors that I would argue look expensive relative to kind of where private market values are trading. But generally speaking, when we think about this public-private arbitrage, we're looking at kind of implied cap rates versus where we're seeing transactional activity in a given market or in a given property sector. Implied cap rates for those in the audience who may not be as well versed, it's essentially the cap rate that the market, that is the everyday mechanism the market is ascribing to a stream of NOI, net operating income, to say here's the fair market value essentially of the real estate as ascribed by the market. And so where we see the most compelling opportunities, at least from this perspective, in the apartment space and the strip center space. And I'll provide a few comments on both. The apartment space, look, the kind of weighted average of the listed apartment names today is, call it a 5.8. Some of the quality names are trading north of a 6. We are seeing fairly representative transactions occur in the market, or we have seen them occur over the last 6 to 12 months at high 4s, frankly, for the best of assets, but really pretty regularly in the low to mid 5s. So if you think about kind of a low 5 cap rate on an implied cap of 5.8 to 6, it would suggest a real valuation discount. The market's right, or the private market's right. They probably meet in the middle, the truth is, but the fact of the matter, it still provides pretty compelling opportunity, especially given that apartments have historically been a fairly favored asset class of institutional investors, large checks, liquid asset class, a good thematic that many institutional investors around the globe can understand. So we think really compelling opportunities in the apartment space from this perspective. And I also mentioned the strip sector. As we look at kind of implied cap sector average, weighted average for the strips, the listed strips, we see them trading at, call it a 7% implied cap, some higher, some lower. But a lot of the really good marks that we've seen, transaction marks that is, over the last 6 to 12 months, have been, call it mid to high 5s for the highest quality stuff, but low to mid 6s for what you'd call representative assets in many of these REIT markets. So again, if you think about 7% implied cap rates versus the market transacting at 6 and 6.25 caps, that would suggest that there is a fairly compelling opportunity. Even if the private markets and the public markets meet somewhere in the middle, it's clearly a good kind of alpha or value generating opportunity. On the strips more broadly, I think worth adding, retail and the narratives around retail from much of the end of the last cycle, if you go back to 2015, 16, and think right on through to the beginning of COVID, the retail apocalypse, e-commerce growth. Money was largely free, if you remember those days. Mike, we'll give you 2% financing on everything. So the narratives around the death of retail are largely have been set on the back burner. Maybe we'll talk about retail later, maybe we won't. But I think a lot of allocators globally are under allocated to retail, not just in the US, but in Europe. So when you have this kind of compelling valuation spread and you have many institutional investors who are under allocated from the last cycle, we've seen some real M&A in this sector over the last, call it 24, 36 months, probably 4 or 5 public companies get taken out. I think there's a really compelling opportunity there.
I've had several executives this year say retail will be the property type of the year, which is a big switch from the past. So, and hopefully we will get to that. Another question from audience member. Back in April, the head of Alibaba came forward stating that the rush to build data centers, data center infrastructure is possibly creating a risk of oversupply. He also states that the pace of construction is well ahead of any realistic demand projections. Do you believe that to be true? I will say we're talking about Alibaba, that's China. That could be a little different situation. China never stops to see build, seems to stop building. They build and build and build. They're really good at it. John, why don't you take that one? What about oversupply?
Yeah, I mean, I think that there's definitely a risk, right? And this was very much the deep mind phenomena that if you can train models on much less compute, then maybe you've got a lot of investment going into a lot of technology that will end up being underutilized. I think the it's very, but I think you really have to ask, what are you building for, and how are you building it? Obviously, a lot of what we see is very much hyperscale building, one gigantic tenant. But when we look at the REITs, they've got much more diversified portfolios. They're building for a lot of uses, and their current tenancy is not really built on AI usage. They're really built today on more traditional data center usage. So yeah, I think that when you're in a dynamic environment and you've got an announcement, as Brandon said, I mean, you could barely keep them straight. I think it was this morning or yesterday, Meta, formerly Facebook, announced another. Maybe it was a $3 billion, maybe it was a $5 billion project, um, and we've so it's really, the supply keeps coming online, at least being announced. Now, a lot of these projects have just broken ground or haven't broken ground, but it's definitely one of the bigger questions that's out there.
Mhm. Brandon, any thoughts on that?
Hey, listen, the announcements are so kind of readily available. I think I might have attributed that 3 billion to Alphabet earlier. I don't know where that 3 billion was, but the truth is, John hits the nail on the head, right? There is clearly a view towards the future and these being needed. I think one thing I would add, as far as kind of the Alibaba comment and some comments we've heard perhaps from tech executives here, at least one in particular in the U.S. And I would say this. It is in some ways, even though the Microsofts, the Alphabets, the Metas of the world are investing huge in these data centers, they are also leasing from the public companies and others data centers. And so it is in some sense self-serving to say, hey, boy, we're investing a ton, but we think that maybe there's too much happening here. Please provide us a lower rent. So I'm not saying that's what's happening. I'm suggesting that there is some perhaps bit of self-serving in saying there's too much out there. Either slow it down or provide us a lower rent. The other comment I would make is as regards our kind of signaling our ability to see it coming. Clearly, if you look at the big tech companies here in the U.S. specifically, we're going to have really good insights into when their CapEx starts to drop off materially, and it's not today. The big four are growing 30% year over year as far as kind of investment in AI, in data centers for AI. We'll know fairly quickly, and the fact of the matter is, they're public companies. They report every quarter, and if we start to see any significant change in needs, you'll see it first there in pulling back CapEx and reporting on a quarterly basis. So the market will have to adjust accordingly, but we'll know fairly quickly, I think, at least in the context of the next 2-3 years.
We have an audience member who says, what is necessary? This is such a big issue. What is necessary for a recovery of the office segment? Is there an opportunity in this sector? John, my understanding is there's certain markets, believe New York City's doing quite well on getting those office buildings refilled. But we're a big country. How are we doing on that? What's it going to take?
Yeah, I mean, so we're a big country, and I think different markets are definitely going to have different dynamics, and we're seeing different dynamics right now. I'm sitting in Washington D.C. I think this is a very tough office market, driven in part by sort of government dynamics, driven in part by a little bit of culture. It's been harder to get federal employees back into the office, and so they drive the trends, and so other people don't come back, and so we've seen lackluster return to office, and we don't have a huge amount of really prime Class A top quality offices where, and I think the quality divide in terms of office performance is very real, and it may actually be growing. And so certainly something we're seeing in New York, we're starting to see it in DC. I think we're seeing in other markets is that we've got, a glut of lower quality or mid-level quality office, but we're seeing developments break ground on brand new office because the demand for that top quality office is there. But when you go down the quality spectrum, it's much tougher. So I think I'm not sure that there's a single magic bullet. I think that in some ways people use the mall analogy quite a bit. That you look at who survived in the mall space and who is thriving today in the mall space. It's the companies who were nimble enough and had the ability to put in the capex to reposition those properties, reposition themselves, and reposition the business model. I think that's going to be that may very well be the case with office.
Brandon, we've already established that you are sitting in an office right now. You're back to work, as you should be, being in the real estate business. John mentions this new construction. That new construction now these are really outfitted buildings. They're trying to create an environment where this isn't something you can just do at home. We've got a lot more going on here than you've got at home. But then that brings up the question of, say, a Class A minus or Class B building, which they seem to have very little hope. Maybe you can integrate that aspect of it into the question. I don't know where Brookfield is these days on office, whether you guys are adding or subtracting or holding.
Yeah. So broadly speaking, the flight to quality that John talks about is a phenomenon that we're seeing not just in the U.S., not just in San Francisco, New York, Boston. We're seeing it perhaps in even more pronounced ways in Tokyo and frankly Paris and London, where it is really, to the extent that you've asked employees in this post-COVID world to come back to the office 3 or 4 times a week, frankly, the give is we'll give you real Class A trophy assets. We'll give you amenities. We'll give you the best locations closest to the trains and public transport. So that is a phenomenon that we've seen. Now, from a public security side, we are very focused currently on kind of markets where we've seen inflecting fundamentals. And I'll talk a little bit about New York and the West Coast here, and happy to answer any follow-ups that you or the audience may have. So really, since COVID, let's say when many of these companies, these listed office companies took significant kind of downturns, we have seen basically East Coast markets and New York in particular recover much more quickly than, broadly speaking, West Coast markets, to the extent of some 50 percentage points of outperformance. If you think about an East Coast versus West Coast basket, as represented by the REITs, most of that has been in the last 12 to 18 months, as New York specifically has seen some real momentum. I guess what I would characterize is, at the end of the day, in New York specifically, what you've seen is more stringent and more stringent return to office mandates. We've seen return to office asks on the West Coast, but we've not seen a ton of enforcement up and down from Seattle to San Fran to LA. In New York specifically, led many cases by the financial services, but driven by the broader professional service, we have seen these asks become mandated, and in many cases become enforced with ultimatums, if you will. And so that return to office has frankly, driven a return to people living in the city. That is, New York specifically, rents continue to move higher near record levels. But when you think about the lack of building over the last 4 or 5 years in New York, so you go into COVID, inflation starts, costs are exorbitant. There's not a lot of building. John referenced that there are some new builds being started, but the fact of the matter is supply has fallen off significantly. So if you are a quality employer, tech, financial services, pick your industry, advertising, and you have kind of growth plans 3 to 5 years out, you need to be moving today, kind of fear of missing out, FOMO in the market. You need to be moving today to secure 100 to 200,000 square foot spots for 2028, 2029. So, kind of return to office, this strength in New York has led to this kind of fear of missing out. We better get this lease signed. At the end of the day, that's created a great dynamic in New York, but it's primarily, as we talked about earlier, driven by kind of quality assets, A plus, and not so much by your A minus, B plus. That was your question, Mike. What happens of those assets? I think in many cases in Chicago, in New York, non-good submarkets, non-good asset quality are going to sit there until the basis falls enough that some redevelopment opportunity, whether it be from a listed company or a private company, develops. But most of those assets are going to require significant CapEx. So the discounts that you're going to see on the last transaction value, whether that transaction was 5 years ago or 10 years ago, we've seen some pretty eye-popping numbers as far as value traded at today versus what it last traded at, 50, 60, 70%. And I think you will continue to see those numbers because there's just not a lot of ways to make Class B office space appealing in this post-COVID world.
Yeah. It's an expensive business. Absolutely. I think part of what we're seeing, just based on some of the analysis, is that there are the people who are really serious about their career are going to go to the office because they need to be face to face with the boss because they're looking to move up. Those who are just, hey, I like what I do, I'm happy to just sit here. They're not so interested necessarily in going in the office. You're not going to get promoted by always being on the other side of a screen with your boss. You've got to be there. He or she needs to know that you've got the style, you have the savoir-faire that's necessary to actually be a leader or a higher ranking executive. That's my side commentary. And we might get back to office again before this is over, but John, I can't continue the discussion without at least making sure that I insert this whole so-called big beautiful bill. I hate that name, but there are implications there for real estate, for publicly traded real estate and real estate in general. What does it mean for REITs?
Yeah, thanks, Mike. And yeah, the big beautiful bill, although that was not, it didn't end up being the official name. I think that's the name that will go down in history. And I would say that real estate generally and REITs came out of this process in a good position. When we think about sort of some of the key rates that really end up mattering for real estate, of course, obviously the individual tax rate is important. The individual tax rates were essentially unchanged. There were, obviously some special wrinkles thrown in to reduce tax rates for people at various levels of income who get overtime and things like that. But the basic marginal tax rates for on income were essentially unchanged. The top tax rate is 37%. And then really importantly, the 199A provisions, which, not something that institutional investors end up thinking a lot about, but really important for individuals, especially in the high net worth channel. The 199A provisions, essentially also called the qualified business income deduction and the qualified REIT income dividend deduction, which is essentially a 20% haircut on the tax rate on qualified real estate income and qualified REIT dividends. And what's really important, so that basically reduces your tax rate on a REIT dividend from 37% down to 29.6%. So a really significant reduction, and that has been made permanent. That was a temporary provision in the 2017 bill. It's now a permanent provision of the tax code. And I think what's really important and maybe misunderstood or not as well understood as it should be is that this 199A provision generally has a lot of restrictions and sort of caveats that apply to it. But for REITs, it's really quite simple. Every dollar of REIT dividend that is this an ordinary REIT dividend actually gets the 199A deduction. So it's something that, again, in the wealth channel for financial advisors, individuals, it's really important and makes a big difference in your after-tax returns. So overall, we were pleased with the way the bill turned out for real estate and REITs. And you know, obviously these are permanent provisions, meaning permanent until Congress changes them. So, but Washington D.C. permanent.
Brandon, you know, in the broader market within the REIT sectors, there appears to be growing interest and demand in growth stocks. Growth stocks being, you know, the stock of a company that's expected to grow its earnings and revenue at an above average rate compared with either the broader market or its industry peers. Is this if this trend is to continue, are there REIT sectors that are better positioned? Are valuations attractive in these sectors? What do you see?
Yeah. So look, I think the market here from a factor perspective has kind of long been infatuated with growth and momentum. We saw that pre-COVID. We may have taken a brief pause, but certainly have seen that post-COVID as well, with the exception of a handful of notable pullbacks in the broader markets. I guess I would suggest that broadly speaking, you know, REIT investors also appreciate growth. They appreciate the visibility of growth, the durability of growth, the quality of that growth. So we have tended to see, you know, over kind of longer periods of time, not in any given week or quarter, we have tended to see names and sectors that can provide that growth and that visibility of the growth outperform, broadly speaking. And when we think about where the best opportunities today are, I guess I'd point to a couple. We mentioned data centers earlier. The fact of the matter is, even with the CapEx expenditures being significant, that spend generally should lead to kind of longer term growth that looks like the mid to high, let's just say high single digits at some point for an extended period of time. That is appealing for most REIT investors at the right valuation. The seniors housing space, Mike, is a space that has seen tremendous total return performance, those listed stocks that are classified as seniors housing space. But when you think about the growth that they have delivered and can continue to deliver, it is indeed compelling. It's occupancy gains off of COVID troughs. It is rental rate gains as portfolios tighten, as occupancies fill. It is demographic tailwinds, the silver tsunami, as many in our industry like to call it. So the fact of the matter is, there will be fits and starts from a total return perspective, but as we underwrite the seniors housing space, we can say, hey, this is an asset class that should grow kind of at, frankly, for a number of years, double-digit earnings growth. There's a higher multiple that REIT investors, that we and many REIT investors are willing to pay for that, in line with kind of broader market trends. We spend a lot more time today as investors looking at PEG ratios, that is kind of price to earnings growth as kind of an adjuster, instead of just how cheap is it from a discount to NAV or a gross asset value perspective. So data centers, seniors housing, retail. I mentioned it earlier. The fact of the matter is, you said, Mike, somebody told you that it will be a strong performer. It will have to have a strong second half to outperform, frankly, the REITs, because it had a terrible first half. But as you look kind of out, what we know is that leases being signed today at kind of large mark-to-markets are 5, 7, 10-year leases. There's still occupancy gains to be had. Rate growth is pretty compelling. Supply is at a 15-year low. And REIT investors don't love the concept of paying today for earnings tomorrow. That is CapEx loads today to fill a space, whether it be a data center or a retail facility. But some of these upfront investments today can lead to that sustained growth that I talked about, that durable growth of 3 to 5% at the right valuation. Pretty compelling. So long-winded way of saying, yes, we are still focused on kind of some of these growth trends, specifically where we can get durable growth. It's not going to be the 13% that kind of forward earnings would suggest in the S&P, but where we can find growth, we tend to be willing to pay up for it.
Brandon, if I could just add on to that, one of the things that's really interesting is we track REIT holdings of generalist investors. It's just sort of people benchmarking against the S&P 500, Russell 1000. And one of the very interesting things that we saw recently was, for maybe the first time ever, we saw generalist growth funds overweight to REITs. So they're seeing those growth opportunities as well, and going overweight, which traditionally generalists tend to be underweight to REITs on average. So this is kind of a very interesting dynamic where they're certainly seeing those growth trends in the data centers, in the towers, I think, certainly in senior housing, and jumping on that bandwagon.
So, John, as part of the mosaic, Brandon's answer, he mentioned again data centers, and we do have a question from our audience, one of our audience members, who says any geographic markets where that have the largest risk of data center oversupply. What's interesting about this, though, John, is that there's areas where they'd like to build and they can't because there's not a power supply there. So there's almost like blackout areas of the United States, and I'm sure other parts of the world. Would you be pointing to any particular regions of the country where there's oversupply? I mean, data centers are really national in their utilization, right?
Yeah, I mean, and this probably gets a little bit beyond my expertise in data center geographies, but I certainly something that I've noticed as just kind of anecdotally is that it definitely seems like in the balance between the cost of energy and the connectivity to sort of internet nodes, the cost of energy is definitely winning out, right? So we're seeing some of these big AI-driven capex projects like that the Metas and Googles are participating in. They seem like they're very much driven by the energy costs in specific locations, rather than more traditionally we'd see a lot of sightings in Northern Virginia near internet nodes, and because you wanted that interconnectivity. A lot of these seem like they're built on pure compute horsepower, less driven by connectivity. So you just want, it doesn't really matter where you are, as long as the energy prices are low, you can get access to that energy. That seems to me to be the driver. Whether if you're not using those for pure sort of AI compute, how transferable those are to broader usage, I think is going to be a question mark.
Mm-hmm. Gotcha. So I do want to talk a little bit more retail with you, Brandon, because you seem to be locked in on the subject right now. Newmark just came out with a new study showing resurgence among U.S. shopping malls. And I'm going to read a little summary from that to you. And this is something we're going to highlight in the September issue of Real Assets Advisor magazine. But the report says Class A malls aren't just holding steady, they're excelling. The data consistently show many malls are well located, well capitalized, have strong occupancy, and are posting steady visitor numbers, all factors that help drive sales. What's more, many are expertly managed and showing significant evolution through the addition of new types of tenants, technology integration, a lot of experiential programming, all designed to encourage today's consumers. And I was going to make one other point there, Brandon. They are talking about a third golden age of retail. I don't know what that really means. Third revolution in agriculture, yes. Golden age of retail, I don't know about that. But here you've got these malls that are suddenly stepping to the fore in a big way, technology integration, and really creating experiences for people. What does that say to you?
Yeah.
By the way, I'll just add real quickly, a lot of these malls are owned by REITs. Almost a lot of them.
So a couple of comments here. So when you think about retail broadly, at least in the listed space, but really in the private space as well, there's open air centers, let's call them the strip centers here in the listed space, and then there's malls. I think they have a lot of things in common. Then there, of course, are differences driving the fundamentals and ultimately kind of the return expectations. What they have in common is that they both kind of struggled in some sense during this retail apocalypse narrative and this massive spend on e-commerce into COVID. What they both have in common is out of COVID, there was a realization by large retailers, the Walmarts, the Targets of the world, those that are more likely to be in malls, that, hey, there is a real value proposition to brick and mortar real estate. If the brick and mortar real estate is in a quality location and it drives quality traffic, there's a real reason to be there, whether it's to sell products or take returns. And so I would say that brick and mortar got a reprieve, kind of surprisingly, from COVID, in that it forced investors and retailers, more importantly, to think of the store differently. So the presence of the store, it still is required to be in a good location. It's still required to have good demographics that drive foot traffic. But again, I think that's the same for strips and for malls. Now, I'll make a couple comments on both sectors. For the strip centers, right, this is where the listed companies and kind of the large players in the private space, they've increasingly shifted their portfolios towards more of that needs-driven kind of center. Right? You've got a grocery-anchored center, and you've got maybe a medical office, maybe a pediatrician's office, maybe a place where you get your nails and your pizza at the same nails done and pizza at the same time. So really kind of impressive movements and transitions of portfolios by kind of large, sophisticated operators pre-COVID to be in really good position to take advantage of kind of this new environment. We're seeing for the malls and the strips alike, kind of record leasing numbers, high occupancies, large kind of mark-to-markets on the rents. Malls, let's go to the experiential side, right? So what malls have figured out, the Simon Property, Macerich, et cetera, is that the fact of the matter is, now that we have, I don't want to say gotten rid, a lot of these C and B quality malls still sit in suburbs of America, they sit empty. To that question earlier about what will it take to redevelop some of these office assets, similar answer to a C or a B class mall. Don't know. The basis will have to fall such that some developer can see kind of the capex that gets to a realistic return or a reliable return. But as far as the malls, the move has long been towards a more experiential. How do you bring people in to enjoy not just an hour at the mall to go buy their suit at Macy's or their athletic clothes at Nordstrom, but to actually get them there for an afternoon, to get them there for a lunch, to do some shopping, maybe to go watch a movie, and maybe even have dinner. So we've seen that, but I think the COVID experience probably made some appreciate that experience more than maybe they did pre-COVID. And some of that's been driven by the retailer saying, hey, we want this. And some of it's been driven by just cultural changes that may have come about because of COVID. So we are constructive. I know it's been an underperforming asset class in the public markets year to date. Some of that is certainly tariff driven. If the retailers are forced to kind of take on some of these pricing pressures, what does that mean to how much rent they're willing to pay? Some of it is, of course, driven by a return to normal bankruptcy levels. 21, 22, 23. We saw a lot of, let's just say, below average retailers that were able to maybe survive because of stimulus and an extra juiced up consumer. So we've seen a return to normal over the last 12 to 18 months from bankruptcy. But again, if you can get past kind of these short-term structural tariffs, more bankruptcies, CapEx, I do think that there is a totally different kind of long-term narrative and potential growth trajectory for retail than existed certainly pre-COVID.
Mm-hmm. Mike, and Brandon, just one thing to add there is that one of the things we've certainly heard from some of the REIT strip centers is kind of about their changing tenant base, right? That with work from home, they've got retailers realizing that some of their customers are sort of around maybe 3, maybe 4 days a week versus just the weekends before. So they're seeing some retailers who previously would have been mall or sort of high street downtown retailers start to investigate the idea of being in strip centers. And then the impact of these sort of tech-driven gyms that can jump into a retail space and with very low labor costs be up and running very quickly is I would say in my local strip center, we've got 2 gyms and a place where you can take golf lessons indoors. It's like none of which could have existed, I think, 10 years ago because they're all tech enabled.
Yeah, there you go. John, inflation concerns. When I wrote this question down, I said, inflation concerns persist, but they actually have jumped up a little bit. We just got a report that inflation's on the rise. Trump administration has been saying, see, the tariffs don't cause inflation, but they haven't been enforced very long, and they have not been enforced at the rates that he's threatened. Now we're starting to see a little bit of inflation. So how serious is inflation in terms of construction materials? In fact, we have an audience member who said, was asking about, what's your take on sustainable materials being utilized as construction materials, but just construction materials in general, with inflation still there, how big a factor has this been in making new construction pencil?
Yeah, I mean, I think between higher construction costs, both due to the inputs as well as difficulties sourcing labor, plus rates, it's that's why we've seen starts really across the board down. And I think Brandon mentioned retail starts have been at all-time lows. Office starts have been down. Healthcare starts, sort of from 2020 really through the end of last year were virtually non-existent. And so there's a downside to that, obviously, if you're reliant on development for growth, that's problematic. But if you're there as an asset owner, this can create really nice supply demand conditions. I think healthcare is a great example. We look at the performance of senior housing over the last couple of years as and the debt people have Brandon mentioned the silver tsunami, which I always like to note is a bit of a microaggression, Brandon. But you're forgiven. But like the demographics are no surprise, right? We've known what was going to happen to demographics for 30 years. We could see the pace of aging in America, and everything has arrived pretty much right on time. But in some sense, there was the slowdown in supply into that market really starting in 2020, which obviously difficult period for senior housing, but that's part of why senior housing is performing so well today, in my view. So I would say that higher construction costs, they're going to be a burden on the development side, but that depending on the structure of your portfolio, that can work for you or against you. The other thing I'll note is just that when we look back at the historic data, what we see is that REITs and broader commercial real estate, can perform well during periods of higher inflation, lower inflation, moderate inflation. Same with the rate regime. What really ends up being sometimes challenging from a returns perspective is that move from a lower to higher rate environment. That's where we see historically we see the underperformance. My sense is that we may see a tick up in CPI. I think a lot of this depends on whether what we're seeing on the tariff front is bluster, negotiating tactics, call it what you want, and we'll see what actually lands in terms of these tariffs. Is really what's going to drive both CPI and then the rate environment, and that's very much. But I think that's mostly going to be short-term noise in a world where I think we're not going to see even in a world of where CPI drops to 2%, we get core inflation running at the Fed's target. Yeah, we'll see some Fed rate cuts, but I don't think we're still going to be in a world with we're not going back to a world of a 2% 10-year treasury. I think we're in a world of moderate interest rates for quite some time.
Mm-hmm. Hey, Brandon. So, as you know, cities like San Francisco, Philadelphia, Minneapolis, San Diego, and others have decided to ban algorithmic rent setting software, basically dynamic pricing, just like they do with ticket sales for concerts and sporting events, which has been very effective, but has put a lot of stress on renters. What do you make of the bans, and how might they influence multifamily REITs in the near and longer term future?
Yeah, so a couple of, I guess, comments here, Mike. Third-party pricing platforms, algorithmic pricing, they have been part of kind of the equation for, let's just say, a decade and a half, better part of 2 decades, frankly, for the listed REITs and for the private operators as well. I think what some of these bans are going to do and some of the litigation that's currently working its way through the federal courts as regards third-party pricing is it's going to make operating a multifamily portfolio or asset more challenging for smaller operators, for mom and pops. Frankly, at the end of the day, in a 3 or a 5 year period, market rents will move towards the market. Whether you lick your finger and put it in the air to price your unit, or whether or not you have an algorithm to price your unit, market rents will trend in the right direction, up or down, with where the market supply and demand are. But from a day-to-day pricing of a unit, if you're being told as mom and pop that you can't use algorithms, you can't use third-party platforms, it's just going to get harder for you relative to the well-capitalized REITs, well-capitalized private players who are going to find workarounds, right? I mean, it's similar to the tax law. They say for every tax law, there's a tax workaround, or there's a lawyer who can find a tax workaround. I'm not saying that there will be workarounds. I'm saying the fact of the matter is, if you're a large, well-capitalized, sophisticated operator in the public or private space, you probably have an opportunity here to consolidate over the next 3 to 5 years some of the space, especially those smaller, more regional mom and pop operators who are going to find it more difficult to operate in this environment. So I think these rules, regulations, I guess they make sense in some sense from the legislators to protect tenants, but I don't think it's doing any favors to those smaller mom and pop operators. I think ultimately it leads to more consolidation in the space, and is probably a long-term net neutral to positive for the listed REITs, frankly.
Mm-hmm. Well, we've touched on a lot of different asset types, but our time is up. John Worth of Nareit, Brandon Benjamin of Brookfield Asset Management, thank you for sharing your insights, your data, your perspectives, and to our audience members, we thank you for your attendance and participation. Please be apprised that our next REIT webinar is scheduled for October 7, where we'll be reviewing the third quarter performance of publicly traded REITs. Keep an eye out for that publicity and registration information. And we hope to see you there. On behalf of IREI and Real Assets Advisor Magazine, this is Mike Consol wishing you all a good day and a fabulous third quarter of 2025.